Hello, and welcome to the April Market Update. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. It was a tough month for the markets. Both here in the U.S. and around the world, markets were in general down between 1 and 2%. And the question is why? Here in the U.S., there were a couple of reasons. The first and the most significant was because earnings estimates were revised down. In fact, companies are now expected to make less money than last year in the first half of the year. This is fairly unusual, and it raises a couple of questions. First of all, why is this? And second of all, what does it mean for the wider economy? The reason it matters for the wider economy is because historically, when we've seen this, it's been a harbinger of recession. In other words, when stock earnings estimates go down that much, we'll probably have a recession on the way. I don't think that's the case this time. I think there are two factors which are driving earnings down. One is the strong dollar. The other is collapse in oil prices, which are actually overall positive for the U.S. So I don't think we can count on this as a harbinger of recession. I admit we've seen some weak economic results recently. We've seen personal spending come in at a much, much lower growth rate than we expected. We've seen business expense down as well. But what you have to remember here is historically when that's happened, it's been because people don't have the money to spend. That is emphatically not the case now. Job growth is very strong. In fact, in the past 12 months, we created more jobs than at any point in the 2000s. More jobs than we created at any one-year period since the late 1990s. Job growth is amazingly strong. Personal income growth is also strong. So the fact that people are not spending the money, that they're saving it, short term, yes, that's an economic hit, but it's more an indicator of long-term strength. It's more an indicator of how we're going to have a sustainable, strengthening recovery. So I'm not worried about the current weakness. Other reasons why we've had weak results is weather. We saw this last year. You heard a lot last year about how the economy was going back into the ground. Didn't happen. Growth picked up. I think we're going to see that again this year. The other thing that really makes me cheerful about this is the housing market is strengthening. We've seen home sales tick up for both new and used homes. We're seeing household formation among the 20 to 29 age group ticking up. These are the people who are going to buy houses in the future. They're getting jobs. And when people get jobs, when people buy houses, consumer spending rises again if they have the savings to back it up, which they will. Put all of the pieces together, we have a short-term hit. We have a short-term hit to the real economy because of the weather. We have a short-term hit to the stock market because of the collapse in oil and because of the strong dollar. But all of those features are better for future growth. What do we see going forward? We see faster growth. The environment remains supportive for the market. We might see a bit more of a pullback, but nonetheless, the environment does remain supportive. So I think when I talk to you in another month, we'll hopefully have some more good news, and I'll be able to say that spring is coming. With that, thank you very much, and I'll talk to you next month.